Welcome to vTalkInsight, Risk Sentiment Daily for April 20th, 2026. Global equities are pushing deeper into record territory, even as the Middle East energy shock grinds on in the background. Today we unpack how an AI and earnings-fueled rally is colliding with mounting stagflation and tail risk concerns. Risk sentiment is firmly on the risk-on side, but with clear fault lines underneath. Major U.S. equity indices have not only recovered recent drawdowns, they have moved on to fresh highs, with the S&P 500 logging strong weekly gains and the Nasdaq extending a long winning streak. Volatility has slipped below the psychologically important level of 20, signaling that markets are comfortable taking risk again. This upbeat tone is supported by broadening participation beyond mega-cap tech, rallies in travel and cyclical names, and ongoing inflows into both equities and corporate credit. Recent days have seen robust demand for investment-grade credit, renewed allocations to risk assets through bond and equity funds, and hedge funds clawing back performance as geopolitical headlines turn less alarming. Beneath that, though, the backdrop looks fragile rather than carefree. The rally is heavily predicated on expectations of contained Middle East escalation, ongoing ceasefire progress, and strong earnings delivery, even as physical energy markets remain severely disrupted and long-term growth forecasts have been shaved back. The result is a resilient but brittle risk-on environment, where positioning and flows favor carry and growth exposures, yet the margin for macro or policy disappointment is shrinking. The most important bullish engine right now is AI and earnings-led equity strength. Across the S&P 500, profit growth is running well ahead of expectations, with projections for around low teens earnings growth this quarter and high teens over the next year, even after analysts have trimmed some numbers. That earnings resilience is a key reason why U.S. equities have outperformed more energy-exposed European markets. Technology and semiconductors sit at the core of the story. AI infrastructure demand is driving powerful revenue growth for hyperscalers and chipmakers, with cloud businesses expected to grow at very high double-digit rates and no visible cracks yet in the build-out across the Asian supply chain. Software and platform names are seen as still early in their AI monetization cycle, while sector valuations have cooled from last year's extremes, with multiples in the low 20s instead of the 30s, keeping the growth trade alive. Importantly, the earnings support is not confined to pure tech. Travel-related stocks such as airlines and cruise lines have posted outsized gains on the back of lower headline fuel costs, and industrial metals strength is signaling solid demand for capital goods, even if part of that move also reflects supply constraints. Altogether, robust micro data allow investors to look through some geopolitical noise, though the bar for continued earnings beats is getting higher as indices grind to record levels. Alongside fundamentals, powerful technicals and equity scarcity are amplifying the risk-on tone. A significant slice of the recent rally has been driven by short covering, with estimates of tens of billions of dollars in bearish positions forced to unwind, and the basket of most shorted names jumping by well over 10% in a single week. At the same time, a surge in call option buying has created a rare dynamic where equity prices and volatility rise together, reinforcing upside momentum. Systematic strategies have also played their part. Commodity trading advisors and other rules-based funds delivered some of their largest equity purchases on record earlier this month, helping to swing positioning from underweight to closer to neutral, even if that flow is now starting to moderate. Retail activity, particularly through online brokers, has become a more important driver of short-term moves, enabling gamma squeezes in select names when speculative interest builds. On top of that, the supply and demand balance in equities is favorable. Corporate buybacks are expected to significantly exceed new issuance from initial public offerings, creating a sense of scarcity at the index level just as high-profile listings in AI and space are stoking fear of missing out. This technical backdrop supports the tape, but it also means a meaningful portion of the rally is flow-driven, which can reverse quickly if sentiment or volatility shifts. A third tailwind comes from lower yields, a softer dollar, and reduced oil volatility on trading screens. Bond markets have seen benchmark yields edge down from recent peaks, with shorter-dated U.S. Treasuries rallying as volatility retreats toward pre-conflict levels and market chatter grows around potential rate cuts later this year. In the UK, central bank commentary has pushed back against the need for aggressive additional tightening, hinting at a more balanced stance ahead. Currency and commodity moves add to that support. Safe haven demand for the U.S. dollar has faded as Middle East ceasefire prospects improve, contributing to a weaker dollar index over the past couple of weeks and easing financial conditions for many borrowers. Screen oil prices have fallen sharply from recent highs, with Brent around $90 and down roughly 10% at one point, trimming the perceived inflation shock and lifting equity sectors such as consumer discretionary, industrials, and airlines. The caveat is that physical energy markets remain far tighter than futures prices suggest, which limits how far this comfort can stretch. On the bearish side, Middle East energy shock and stagflation risk remain the dominant macro headwind. The effective closure of the Strait of Hormuz under a U.S.-led blockade has taken an estimated 8 to 10 million barrels per day of oil supply off global markets, with actual flows through the corridor still more than 90% below pre-war levels. Restoring damaged infrastructure is expected to cost tens of billions of dollars and could take from several months to a couple of years, even under relatively constructive scenarios. The knock-on effects are already visible. Europe faces the prospect of jet fuel shortages within about 6 weeks, with agencies warning that reserves could be exhausted if disruptions persist, forcing refiners to curb runs, pushing prices higher, and potentially forcing demand rationing and flight cancellations. In Asia and parts of Africa, shortages of crude and refined products are severe, prompting some countries to seek assistance from the International Monetary Fund to cover ballooning energy bills and budget gaps. Strategists warn that a prolonged outage keeping 8 to 10 million barrels offline could see oil spike toward $150 to $200, a scenario that would severely damage global growth and push inflation back up. Forecasts for world growth in 2026 have already been cut by around 0.5 percentage point, with Europe and Asia bearing the brunt while the U.S. remains more insulated. Even if the waterway reopens, structural refining bottlenecks mean that jet fuel, diesel, and gasoline markets could stay tight for years, keeping a stagflationary bias in the outlook that risk assets are not fully pricing. The second key bearish force is valuation and earnings disappointment risk. Equity indices are trading at elevated multiples after a rapid move from oversold to overbought conditions, and the current rally assumes another year of double-digit profit growth for many benchmarks. With that much good news already embedded in prices, the tolerance for any misstep has dropped sharply. Recent earnings season price action shows how unforgiving markets have become. Streaming and technology names have seen their share prices fall close to 10% in a single session on the back of slightly weaker forward guidance, despite still solid current results. In Europe, industrial companies, including major train and infrastructure manufacturers, have lost 20 to 30% of their market value after withdrawing guidance or flagging project delays and margin pressure. At the index level, leadership remains concentrated, with the capitalization-weighted S&P 500 meaningfully outpacing its equal-weighted counterpart, and a small group of AI-linked winners carrying much of the advance. That combination of stretched valuations, narrow breadth, and punitive reactions to even modest disappointments suggests a fragile equilibrium where a few high-profile misses or a downgrade to earnings growth expectations could trigger a broader de-risking. The third bearish driver is market complacency and latent tail risks. There is a growing disconnect between calm financial pricing and the more stressed real economy, particularly in commodities and supply chains. Physical shortages of crude and refined products are biting across Asia and beginning to affect Europe. Industrial metals on major exchanges have jumped by double digits in a matter of weeks, and manufacturers in Asia are already cutting output due to input constraints. At the same time, several potential shock points lurk beneath the surface. Major banks have been active in credit default swaps referencing flagship private credit funds, highlighting concern about liquidity mismatches and redemption limits in that space, while scenario analysis warns that a confidence shock in the U.S. Treasury market could force yields sharply higher if official buyers are left as the main backstop. UK political turmoil has pushed long-dated gilt yields toward the mid-5% area as investors demand a higher risk premium, and uncertainty around Federal Reserve leadership adds another layer of policy risk. Overlay this with new cybersecurity threats from advanced AI tools and the heavy reliance of the current rally on a smooth U.S.-Iran negotiation path, and it becomes clear that markets are pricing a very benign path despite a wide distribution of possible outcomes. To sum up, risk sentiment remains decisively risk-on, powered by AI and earnings-led equity strength, supportive technicals, and easier financial conditions. Yet the Middle East energy shock, stretched valuations, and a range of underpriced tail risks mean this optimism is riding on increasingly narrow foundations. Watching how earnings guidance, physical energy markets, and policy signals evolve from here will be critical in gauging whether today's resilience can persist or whether a repricing of risk lies ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.